here on stage with me, I have Federico from efcom and Magnus from Marsh. I'll ask them to give their own introductions in just a moment. But joining us online, I have Gabriele, who's the CEO and co-founder of Wiserfunding, Karel from Accenture, who's the principal director for working capital and trade finance, and Senem, who is vice president at ABC on the senior relationships side. So, Federico, I'll hand over to you for some intros, if I may.
Thank you, Ben. For those of you who were not here in the morning, for my short intro speech pitch for efcom, my name is Federico Avellán Borgmeyer. I'm a born German, but raised up in Central America, in Nicaragua, a very tiny country, a little bit bigger than Estonia, actually. Yeah, I'm an engineer by training. Studied artificial intelligence and economics at the University of Illinois in Urbana-Champaign and Technische Universität Berlin, and been in different roles in the finance space, from personalization, card systems, transaction processing, PKI. Actually, at the beginning of this world, we have a patent on PKI, or my company had one when I founded Fidelio Networks, and so it goes post-bank, and last but not least, now in the role of Chief Partner Officer at efcom, trying to bring efcom across the globe from a technological point of view, trying to find partners on a global scale and commercial partners as well. I stop here.
Thank you.
Yes, Magnus, Lindgren is my name, and I'm heading the credit specialty of the Nordics for Marsh, which is an insurance broker. So we do credit insurance and surety only. So before that, I've been in this industry for roughly, too long actually, 14 years. But I do have a background with mobile payments, and so I'm not completely lost in the fintech world either. So yeah, that's me.
Good to know.
Brilliant. Gabriele.
Yeah, good afternoon, everybody. You can hear me, yeah?
This is Karel from Accenture.
Yeah, so this is Karel, Krejčí, calling you from Prague. So as you mentioned, I'm a principal director and in charge of the practice working capital, supply chain finance and trade finance at Accenture. Joined Accenture back in September last year, but for the last 10 years plus, working and covering different type of fintechs in the world, probably the 3 largest fintechs in the world. So I think we've got a good grasp of the supply chain finance and trade finance globally.
Gabriele?
Yes, thanks, Ben. Good morning, everyone. My name is Gabriele Sabato. I'm the co-founder and CEO of Wiserfunding from London, here where we're based. Wiserfunding is specialized in predictive credit intelligence for SMEs, so really risk. And that's my background. I've been in risk management pretty much all my career in different banks before starting Wiserfunding 6 years ago. So quite excited to be in this panel, a very relevant topic for today, and yeah, looking forward to the discussion.
Lovely, thank you very much. And Senem, are you with us? You've disappeared from camera.
Oh yes, hi, finally I'm back. Thank you, Ben. And I work for Arab Banking Corporation, and greetings from London. I work at ABC International Bank PLC. It is a full subsidiary of Arab Banking Corporation. I've been a banker for more than 20 years, and I used to work at Bank ABC Turkish office. For the last 3 years, I'm part of receivables and supply chain finance team. So thank you so much for inviting me for this panel. I'm very excited to participate in this panel. Thank you.
Lovely, thank you, Senem. All right, so we've got the after lunch session on risk. and I have been told unequivocally by one of my panelists that we need to keep this upbeat and fun for the afternoon. So we are going to focus very much on the opportunity side of risk here, how approaching risk within this interesting structure can actually provide more opportunity, open new doors, maybe bring other funders, other kinds of client into the mix. As we go through, we'd love to hear your questions. We'll be kind of doing this stage by stage. We're going to look overall at where the risk lies and where that opportunity might lead us before delving into some of the probably fairly obvious areas such as credit risk, fraud, what the risk looks like in things like long-tail supply chain finance and sub-investment grade buyers. If you do have questions as we go along that pertain to these, please do drop them on the app, and we'll do our best to integrate those as we go. Otherwise, we'll definitely pick those up at the end. If you do see questions you particularly like, do give them an upvote so that we can see what's particularly popular out there. So, first off, I'd like to start on the overall view of risk within a transaction, where those different points may lie and how we can assess those to open up new opportunity. And Karel, I'd like to start with you on this one, if I may.
Okay, yeah, so, well, probably from an Accenture perspective or an advisory perspective, what we see is that we do take in account probably different type of risk as well. There's probably supplier bankruptcy, the market volatility, the FX, foreign exchange, the budget overrun, the inflation as well, legal issues, and reputational damage or operational incidents as well. As you may know, Accenture is providing state-of-the-art solutions as well, including AI and data science and technology to reduce and mitigate risk as well. So this is somewhere something that we think it's also a key element into assessing the risk.
Okay, fantastic. And Federico, I know that you at efcom have been doing some very interesting work on kind of modeling out the risks within the supply chain. I know you've got something you wanted to share with us. You got a moment now to go through that?
Let's try.
Great.
Let's try. So I take this off.
Any moment we should have a lovely, there we go, something to look at on the screen.
Can we see something?
Cool.
Okay, yeah.
Yep, we're in.
All right, yes. Maybe a little background before I start talking about the thumbs up and thumbs down here. Supply chain finance. Where is the risk at supply chain finance, if we talk about risk? Any ideas? Who's the biggest risk factor in the supply chain finance space? The buyer, the seller? The buyer, right? Exactly. So, and we're talking normally not about little tiny buyers. We're not talking about one invoice that may probably be at risk. No. If we talk about a big buyer going default, perhaps, we talk about a lot of money. And that particular case could cost your company's existence. So what do we look at? Today in the morning I was talking about efcom and our so-called EF community, our ecosystem. In our ecosystem, we handle about 200 billion euro transaction volume, about 100 million invoices per year. So this is a bunch of invoices. This is a lot of money and a lot of clients, a lot of buyers, a lot of sellers. So all in all, an ecosystem of about 1 million companies. Let's now go into the ecosystem that you see up on the screen. So this is not 1 million. This is something that our data scientists at EFCOM in Frankfurt put together for me for this particular presentation. It's premiere. You're the first one seeing this. We're working on this since a couple of years, and this is an application that should enhance our existing application in order for the factor, the financier, the bank, to see where a risk exposure may be. We've designed this now from the perspective of supply chain finance. That's why it's written supply chain finance and not factoring. Let's look at the thumbs now. The thumbs are buyers. And the thumbs are up. The thumbs may be in the middle, like in the Colosseum in Rome, where you didn't know, is it up or down? And then there is a thumb down in red, meaning something not good. What our system does is, in real time, follow the behavior of payment of a particular, in the factoring world, it would be one, and in the supply chain finance, it would be the buyer. Is the buyer paying accurately, as it should be? Not only to one supplier, but 2, 3, 4, 5. There are companies out there, if they're big tickets. One of my clients used to be Mercedes-Benz. Mercedes-Benz Group has 60,000 suppliers. So you have a big universe. So in this case, you would like to know, as someone who does business with Mercedes-Benz, is they are paying their invoices on time. Because managing all those invoices is difficult. So what you do is you look at them and you just press on the green button. This would be Mercedes-Benz. It's in the manufacturing industry. You see a few green. You see a lot of greens. You see some yellows and a few reds. So all in all, there are some delayed payments, but they're not really threatening. But you keep an eye on it. It's like measuring the vital indicators in your own body, in your own system. Maybe even Mercedes-Benz or any other one wouldn't know what's going on. So you're observing this in real time, and if things are developing in a different direction, perhaps in something like this, where you have a buyer who is in the yellow, meaning there are more yellows, there are some greens, and there are reds. Watch out. Once it becomes critical, which would be, for instance, in this one, then you know, this one is having a trouble. This is having a problem. You're certainly exceeding too many payments out there. The development is dangerous, and have a look. You know, certainly latest by then you should contact the buyer. You should do that obviously before. You could alert them, you could watch them. You can also see that this is the pharmaceutical industry. Maybe it's a particular thing in the pharmaceutical industry. I know our friends here work very much in the construction business, so maybe the construction business is having trouble in general, or maybe a region, a particular country is having risk. And so this particular dashboard gives you an immediate overview on what's happening in your ecosystem right away. So you don't have to read the numbers out there. You have a dashboard that's reading all the behavior in real time of your ecosystem, and you can react accordingly. This is risk, but risk is also opportunity. So we say the one goes along with the other. So it's a yin and yang thing. Where there is no risk, there is no fun, right? So risk and in this case, opportunities go very close together. So this application should help our clients to visualize and to handle accordingly. We're talking about a beta system here, obviously with a bunch of more like recommendation tools. What should you be doing in that particular case? And handle accordingly in a risk, but also in an opportunity from an opportunity point of view. So this is something I wanted to share and show to you if you have questions.
You could probably get a job at any credit insurer whenever you want to. They're going to love you.
I know. This is when we saw this. When I explained to Harsha, this is what we want to do. I mean, our clients are sitting on the oil of the 21st century, right? And we're not really exploiting it. Data, massive amount of data, is in any of our clients. They're sitting on it. Yeah, we all do our job right. I mean, our competitors, we do all our job right. We handle the transactions, we send out messages when there is a delay in payment, etc. We can communicate and connect with other systems in real time, web-based API, whatever you want. But are we really using the data to transform it into information that's existential sometimes, or give you information about how to improve your customer relationship, and tell them, hey, you're doing quite well, or you were not doing so well and you're doing much better, or you're not doing so well anymore, what's going on? Can we help you out? We can tell you the vital systems are telling us something. Maybe you don't even know. Sometimes they don't know. It's like us. We're feeling okay, but something is in our body that's maybe changing, and we don't figure it out until it is too late.
Absolutely.
So this is something that we want to create and, help the industry to become better, faster, etc.
That's great. Thank you, Federico. And that's really interesting. I mean, Magnus, obviously you have a clear interest there. How does this kind of improved data, improved analysis and visibility of the larger ecosystem play into the hands of insurance? How would they look at these kind of risks and use this kind of information?
Yeah, I think it would be essential for future supply chain finance business that is supposed to be insured, because I'd be completely lying to you if I said it's the favorite sport of the credit insurers. It's not. No. So I'm going to try to keep it positive for the remainder. But I think worth knowing is that the very DNA of credit insurance is that it's initiated by the seller. The seller is somehow skeptical whether the buyer can or will or is going to pay sometime in the future. So that is kind of put out of play to start with when it's initiated by the buyer. So it really doesn't tick that box. And as number two, a very large portion of the credit insurance market also prefer the insurance to be confidential to the buyer. So that's box number two that is completely, out the window already. So you have to waive the confidentiality. And number three being the famous concentration risk. And we know the big players in this field, the Atreides, Allianz, Coface, their whole idea is to have portfolio risk to spread it. And here, the whole concept of the spotlight on one buyer is not really doing the trick either. And finally, there is also, again, coming back to the transparency, the track record of supply chain finance, reverse factoring, has a bit of a... they've lost a lot of money on it, to put it like that, the insurers. So, and I think you all know the cases. So we have a little exercise to do to make it more attractive, and I'll come back to that later on, I guess.
Okay, great stuff. Federico.
I would like to add something on Magnus here. Intervention. I remember when Jose, our partner from Barcelona, from Tecfofin, and I, when I received this phone call from a friend of mine in Guatemala, in Central America, he was promoted to become vice finance minister, and he said, Federico, you have to come to Guatemala right away. I said, what's going on in Guatemala? Well, we just passed on this legislation about doing factoring in Guatemala, so I know that you're in factoring, so you have to come now, be the first one. So I told Jose, we have to go to Guatemala right away. Boom, be the first one. So we went to Guatemala, we're the first one, talked to the ministers, back and forth, talked to companies. And then at some point in time, we were explaining to them the concept of factoring, supply chain finance, and so forth. And at some point, we came to the point of credit insurance. And then they said, what's that? Well, if you're going to this business, it would be good if you can insure your, your invoice and stuff. So, Federico, we don't have that here. We know nothing.
No. Interesting. And Senem, from a banking perspective, how does all this fit? How does your bank view the inclusion of technology to get this deeper level of type of risk and insurance as a mitigant within your structures? How does that work within ABC?
Yes. First of all, this was really impressive, Federico. And I think as banks, we should be also looking at this type of tools more often. Right now, we're a little bit traditional from a traditional aspect. In a more old school way, we do the things. First, we try to understand the industry, the sector. We do some lot of health checks on the obligors, looking at the trading history. We also rely on, of course, some feedback updates from the insurance companies, which we use as risk mitigants. And I think we want to understand deeply, in a deeper sense, the whole entire supply chain with the buyer and all the suppliers. And on the receivable finance side, of course, it's very important for us to understand the risk of the obligors, the buyers. And when I look at this tool, I think it must be quite useful tool, especially for exporters, if they want to expand their business in a worldwide across other countries. And when it's a buyer-led financing, it's a more, kind of, some people call reverse factoring. We should be looking at, of course, the suppliers' reputational risk and to understand these, to do some health checks on the suppliers, especially there are ever-growing sanctions all over the world, and we have to be comfortable with the suppliers' names. Especially, it's also important for the buyer to be comfortable with the new suppliers. I think more and more we should be also. Yeah, I mean, we're using some kind of course. Some reports available to us about the sector and the suppliers, but I think there's always room that we can expand our avenues to do more checks and to understand more in depth the sector and the business model.
Thank you, Senem. And I mean, using that kind of additional insight, that kind of additional data, what kind of new opportunities does that open up from a financing and bank perspective?
Yes, I think our risk appetite may be restricted, a little bit restricted, I must say. It is restricted to the information, the data we obtain. For example, we speak to our local branches, local offices, get the reports and etc. But maybe with some more technological, tools, we will have more information. This will increase our risk appetite, and we will know better. We will understand better these companies, and we will feel more comfortable, I think.
Yeah, I think that's been a very common theme throughout the last couple of days, is that of kind of understanding and knowledge and visibility. Gabriele, I know this is something that you guys at Wiserfunding work on hugely. That kind of holistic view of the SME risk particularly, and helping your clients to understand that. How do you see this kind of driving new opportunity and opening up new doors that would previously have been closed?
Yeah, thanks, Ben. It's extremely relevant. I would start probably picking up from where Federico left, I mean, data is the new oil. That's what he said, and I think that's the reality. I mean, today is a lot of data available out there. Most banks and non-bank lenders, supply chain finance is a typical example, is moving away from the old traditional relationship management approach. So everything is becoming digital. Data is the only way to basically make sure that you can be fully digital and take that opportunity of growing, scaling very quickly in multiple geographies. So data, that's the basic of everything, but at the same time, a lot of data is hard to be processed, right? So you need to make sure that, you know, as volume pick up, you are able to consider all these different type of data. You know, before Karel mentioned, you know, macroeconomic, financial data, non-financial data. We take more than 800 data points for each company that we assess, right? And this is a mixture of structured, unstructured data. Obviously, any credit analyst could assess all of them, but it would take a long time. And that's the ability that we put in place there, is to process this data in a way that can become easier to consume. And I think this is the secret. The opportunity is in that capability of processing a large amount of data and transforming it to insights, so that really what lenders can do is enjoy the benefits of digitalization, innovation, and basically become more efficient, being able to assess a larger volume of company in a smaller period of time. That efficiency is required not just because of the increased number of companies needing funding, but also because obviously we are in an economic cycle that requires more attention. I mean, inevitably we can't hide behind obviously what's happening around us. It's fair to say that, you know, in many European countries, we're moving into a downturn. And that economic downturn, we see it every day. We see the number of insolvencies, bankruptcy increasing in many countries. A lot of the buyers or sellers are clearly over-leveraged after the pandemic, and the support they've got from governments or non-government institutions. So this all drives to one point, which is, you know, risk. The underlying theme of this panel is a fundamental element to drive the strategy. If lenders want to truly enjoy the opportunities of the supply chain finance, obviously they will need to be ready and prepared to assess the right type of information, do it quickly, and, you know, work on the actions based on that data to provide credit, to set limits, to set the right level of pricing. So there are so many decisions that will need to follow. So I think that's probably the opportunity I see here, like the one of becoming really data-driven and taking opportunity of this digitalization around us that can make things faster and more efficient.
Yeah. May I add something to that?
Please,
because,
absolutely.
I think I agree with everything you say, and the thing that data can do as well, it can provide an objective view, because seller-buyer relations are usually long and they're good and emotionally driven, and we see, for instance, that most credit losses do not come from ad hoc business. It actually comes in long-term relations, because people's minds get clouded, you know, and people mix up willingness to pay with ability to pay. Doesn't matter how many golf rounds you've taken with a guy. If he doesn't have the money, he doesn't have the money. So with the correct set of data analysis, you can also provide people with a tool that is more objective in this sense.
Mm-hmm. Absolutely. Just quickly, coming back to you, Karel, obviously you see things probably from a slightly different perspective. You'll see kind of cross-funders, cross-corporates, you'll see things in various different scopes. what do you have any kind of final thoughts on this kind of overarching risk topic, and how the approaches to this can open up opportunity?
Can you repeat the question? Sorry.
Yeah, sorry, Karel. Just say that, from your kind of broad perspective and how you've seen people deploying technology and kind of, reviewing the overall risk in transactions in order to open up opportunity.
Yeah, so probably I would say buyers. I think that for the lenders, it's always a question, as we just mentioned, to have the right data, to have the right opportunity, and to assess the opportunity about the buyer, and make sure that probably all the suppliers behind are eligible and why they are eligible for this kind of scheme, and making sure that to reduce the risk in terms of default or anything else around the SCF. There is a big need around data enrichment and having more information, or working more upfront any program implementation program where you need to do more supplier assessment and supplier segmentation, working cap analysis as well.
Please.
I would like to add here one thing, and I think it was yesterday that I don't remember who mentioned ESG. And ESG is something, Michael, we've been talking for a year now, right? In our space, and I think ESG can also pose at the same time as the buyer risk, but in the supplier, if we look at the supplier, let's say portfolio that one buyer may have, that is an inherent risk as well. What kind of suppliers do you have there? Are they compliant with ESG or not? Where are they moving? Are they, it doesn't matter if it's an E or the social part, or even the government governance part in corruption and stuff. Are we measuring that right? And if I look back at my dashboard that we saw as how is the behavior in payment, but also how is the development in ESG compliance moving in your supplier portfolio? Is the supplier heading towards ESG compliance or away from it? And all that is also inherent risk in your portfolio, in my opinion, and chance, of course.
No, absolutely. I mean, I think, the overarching of risk is a very large topic. And, trying to bring in all of those elements, we've just touched on that kind of upfront analysis, but of what? Credit, ESG, operational risk. There are a whole variety of risk elements here that need to be assessed quickly and effectively upfront. And it's really interesting. We've seen quite a move over the last couple of years to a desire to get that upfront, also partly because of the competitive nature of this sector. As more and more fintechs grow, as more and more people like these asset classes, that actually these opportunities become more hotly contested. So the ability for an organization to actually be able to assess what an opportunity looks like, not just now, but over time, and therefore what that might look like in the future, also creates an opportunity for enhanced competitiveness and the ability to structure programs that run very nicely to the working capital requirements of an organization. So I think, the use of technology and data within that is obviously critical. And Gabriele, I think you touched on kind of the global disruption, increased levels of uncertainty, people kind of securing more local supply chains. What has that uncertainty meant to managing particularly credit risk across SCF portfolios? Karel, again, can I come back to you first on this one?
Yeah, sure. So, sorry, I didn't follow this one. Sorry. Can you repeat this question?
It's essentially around, what the increased levels of uncertainty have meant for kind of the initial analysis of the credit side of supply chain finance portfolios, what complications that's meant?
Well, I think if you don't have access to data, or you don't know your buyer and its supplier and the ecosystem around, probably you won't be able to have the right product or even the right pricing and put in place a sustainable solution for the suppliers. And because we just mentioned ESG programs, for example, being one of the solutions, one of the trends applying and offering as of today, I think it's very important for every party to have access to data and being able to assess the right opportunity.
Great. Thanks, Karel. Any other points on kind of the upfront analysis, initial credit risk before we move on to the next? Because Magnus, otherwise I'd like to jump over to you around, obviously one of the major risks that I think that the insurers often see with that traditional supply chain finance is the concentration risk. You know, the higher chances of things like potential collusion, the very lumpy risk that some insurers don't like. How do insurers kind of see this market?
I had a feeling you were going to ask that, so I actually called one of them. No, seriously, I did. So just to see, can you tell me what is the kind of checklist that you go through if you get a supply chain finance case? I'm going to actually read here. But so 5-6 bullet points. One, on the rating scale of this insurer, the buyer must be 6 or better, 10 being, you know, Bank of England, kind of. They also said the buyer here should not represent more than 30% of the seller's business to make it balanced. On the other end, one supplier should not represent more than 5% of the payables. That's a third box to tick. And one interesting one, out of the financing for this buyer, not more than, the program should not represent more than 30% of the total funding, because again, what the insurers don't like is to be sitting in a scenario where they feel they're the biggest or a lonely guy. And then also, which comes to a very important point, which is trade history. There should be at least a 2-year or longer relationship between the bank here and the buyer. So in this case, very clear tick box list. And I guess there is some maneuvering space, but as I mentioned earlier, there are a few insurers that do not do this at all. There are others that certainly contribute. And if I'll to give you more of a general feel for the parameters you touched upon, of course, the concentration risk as such. There is a whole bunch of insurers that do nothing but concentration risk. So there is a big market for this. But the key word is transparency, being able to see what's going on and being able to monitor the buyer on a regular basis, which means also that the preferable case is with a well-known financing entity, bank, that is actually orchestrating the whole thing and keeping things in an orderly fashion. And maybe finally then, risk sharing. I know we'll speak a little bit later on how you can maybe make this even more attractive, but I think one should maybe think in terms of risk sharing rather than risk transfer. Again, proving as a bank and as a supplier that you still keep skin in the game. You're not just dumping this in the lap of the credit insurers. Is also a way forward.
Excellent.
I have a question to Magnus. Always wanted to know, is these numbers 30%, 5%, is this regulatory or is this best practice from your company?
Yeah, and it's not mine. I actually, like I said, I did call and ask an insurer themselves what are the criteria, and it's completely from their experience. What is a balanced case here? We don't want to, stick out too much in either direction. So completely subjective, but probably some
empirical
empirical background. Yeah.
Okay.
Great stuff. And one of the things you mentioned there, Magnus, as well, was around that kind of historic data and historic performance. Now, one of the questions we've got in from the audience is, when speaking of new opportunities, and there is no historical operational data available, what data do you rely on in those cases, apart from the obvious financial statements and such? Are there ways around a lack of historic trade data?
I think so. I mean, there could be, first of all, the trade data may not exist between the supplier and the buyer, but the bank may be having a long history with the buyer. That's one thing. And also, I think a part of the criteria that I mentioned from this insurer is not related to trade, existing trade. Will this supplier constitute more than 5%? Will the financing solution constitute more than 30% of the total? So yes, there are ways around it, but the trade history linked also to the fraud question, I think the risk of fraud is lower if it is an existing flow. So it's more of an uphill battle if it's a new relationship. There's no doubt about it, but by no means impossible.
But I think this is one of the bottlenecks, right, in our industry. If you want to go to a new market, I was mentioning Guatemala a few minutes ago. So basically, we stay put. So, there is no data, we can't do the business. And that's, I think, when it occurred to me to work on this particular model a few years ago, because then you start from scratch. You start from zero. You have nothing. So you start with the first one, and the second, and the third, and AI will help you to learn from the late payments, from the insolvencies, from the industries in that particular environment, and the system will learn very quick. We have one tool that does that with the payments and open invoices, and within a month time, with the amount of data flowing in, the system gets you from a 50% accuracy up to 90% accuracy. So here's a big opportunity in markets where you have nil, zero.
Correct, and there's actually even a criteria with the insurers which is called building a trade history. And that is very simple. The first invoice, sorry, you're on your own. Mm-hmm. Yes. But once that's paid, you have a trade history of 10. Mm-hmm. And then the second invoice of 10 is paid, then you have a trade history of 20, and then you build up gradually. Exactly. And that's also, to some extent, putting your money where your mouth is, proving yourselves as a supply chain.
You may be paying your dues at the beginning, but the outcome is great. I remember seeing a fintech in Germany, I think it was from Berlin, who were playing that role. They said it was factoring. So they started from zero, and they started buying invoices. And everyone was like, where do you get your information from, all these SMEs? And they said, we don't take any information. It's like, we gain information by every invoice that we purchase.
Mm. Oh, absolutely.
And their experience was amazing. It's like the microcredit case in India. Yeah.
Gabriele, let me pass this one over to you. I mean, we're talking about how to use kind of other forms of data in order to support and set up these kind of programs. You specialize in the SME sector, which is often one of the hardest areas to get other data on. For the big companies, you can go and pull reports, you can get financials, not so for SMEs. How can you approach this from an SME perspective?
Yeah, well, unfortunately, it's not simple. It's private company data has been a difficult one for a long time, but increasingly, again, we're seeing a lot of opportunities there. So a lot of countries today offer you the opportunity to access accounting software, especially cloud accounting software. So a lot of our clients, especially in the supply chain finance, they would request buyers or sellers, well, mostly buyers, access to their accounting software as a precondition before basically accepting them. Second, obviously, I'm sure you're all aware of that, is open banking. Open banking is growing across Europe. So it's, again, mostly in the UK today, we see as a prerequisite to get accepted, even to start the underwriting process, a request to the buyer of basically granting access to their current account or multiple current accounts. And so the lender has basically got the full view of cash flow, balances, management accounts, and this is real time. Let me make this point very clear. Okay, so that's amazing. It's not going back to the filed financials, which may not be there. Payment history may not be there. Even if it's there, sometimes you're probably just looking at a very narrow period. If it's a new client or a new market. So this data is incredible. And then what the market defines as alternative data, everyone calls it in a different way, but it's basically all the unstructured data you can find on the web. So we use social media. We look at adverse news. We look at so many governance, ownership structure. A lot of data is there. It's just a question of knowing where to get them and how to process them. So as you can see, there's plenty of opportunities there to overcome the issue of maybe not having a payment history. The point is always what I was mentioning before. Even when you access this large amount of data and the buyer gives you full access to all this data, you still may be really stoned by an avalanche of data that you need to try to kind of get some sort of insight from. And that's probably the most difficult part.
That makes a lot of sense. I just need to do a very quick check. I believe I've got another 25 minutes. The clock is saying another 40 minutes. What am I aiming for here? Perfect. That's what I thought it was. Right, let's move on in that case. Karel, can I come over to you quickly? When we spoke previously, you were speaking about a rather interesting story. So, SCF, traditionally, it's a buyer-led solution. It is a buyer decision, and that's how it's driven. But it's not always the case. And there are interesting examples out there where actually it may be supplier-driven to actually get these kind of things in place. Can you share that insight with us?
Yeah, absolutely. So across my career, some different programs as well. So either dynamic discounting could be as well a supplier-led solution as well, not only a buyer-led. So perhaps the supplier will propose discounts to a program where, of course, the buyer will have already a discount agreed with a minimum threshold, but usually the supplier is proposing a discount rate, which needs then to be agreed by the buyer. But that can be one of the solutions, yes, instead of a buyer-led program. But probably some things that Senem at banks as well could have seen or could see as well now as an alternative.
Absolutely. Senem, what's your kind of view of that and how these are driven, and what examples have you seen over your time?
Yes, at Bank ABC, we usually do receivable financing, but we also look at the buyer-driven type of financing. We have seen different types of structures. For example, the buyer could be a very strong buyer, for example, well established in UK. And all these suppliers are in Bangladesh and in Turkey, small suppliers operating in these countries. And with this strong buyer under this program, with this structure, they're actually, he's providing financing for these suppliers, which normally they can't borrow in their home country. And I think this is very good because these suppliers are quite happy with this financing provided to them, and they always participate the structure, being part of the facility. And this also helps these suppliers working capital needs and continue their business. And very happily, continue providing all their goods to the buyer. And also there are transactions like, the seller is a strong machinery and equipment manufacturing company, and the buyers all over the world, and it's a global program. And with this, receivable finance facility, and of course the seller is quite happy because, financing these receivables, and we use insurance as a risk mitigant. So we collaborate a lot with the insurance companies, and these, small buyers in different parts of the world, still quite happy with the extended deferred payment terms that the seller provided to them. And they're not exactly aware of this financing. Usually it's undisclosed facility. They're not really aware of the insurance package, but it's just like a win-win situation, I think, for both sides. So they're quite, pleased to continue buying these products on deferred payment terms.
Great. Thank you, Senem. As we're getting short on time, I'm going to skip forward a little and just try and talk a little bit about some of the opportunities that also exist within supply chain finance. We talked a lot about better data, better analysis, being able to get deeper into the supply chain. And Senem, you were just talking there about the fact that, yes, you do the payables, you also do the receivables side. Are there opportunities for that overall support of the supply chain? And I think Jakob touched on it in the previous session, and we're certainly seeing more of it, where previously the large buyer's desire was often to make financial gain out of an SCF program. These days it's far more about supporting the supply chain and giving a good solution, a good product to their suppliers. Are there opportunities to kind of mix and match products into the supply chain? We talk a lot about SCF, we talk a lot about sub-investment grade buyers. Are there better solutions to support all of those areas than traditional just SCF? Federico, maybe I'll start with you on that.
I've been thinking about it lately, yes, because apart from being at efcom, I'm in a board of a company that does manufacturing of goods that are going to be produced over a long period of time with AAA debtors, clients, over 5 years. And we're now in a situation where this small company that needs to work on over 3 to 5 years' time to implement a water plant in, I don't know, in a country outside Germany, far away. We have a project in Hawaii. But of course, these projects take time, and then they need financing. And the question is how supply chain finance can also go into this kind of space. We're talking about going to finance before production. So because you may have to invest a lot. I mean, we're talking projects that go up to 50, 100 million euros over a longer period of time. And so how can you finance that as a small company? The banks would not do that, or with a lot of problems only. So I see a chance in here, especially when you have these AAA debtors on the other side, and start financing from the very early beginning, not when the invoice is out, but maybe from the planning phase already, because that's where these companies need to be helped at. And I don't think this is an exception. Looking around, the world is driven a lot also by projects, one-time things, and how do you deal with these? And we know that when these are one-time projects, the risks are higher, but the opportunities at the same time are much higher as well.
Indeed.
Yes.
Brilliant.
So yeah, go into a space. Risk appetite was mentioned here by yourself, Senem. And so here we go into an area that could be relatively safe, large-scale volumes. And I know that there are a few banks out there in Macquarie in Australia. They do this kind of business, and they're doing quite well. They do a lot of money. They make a lot of money with this kind of focus on these big projects. But why only leave it to them? And in the United States, there are a few banks that do financing of that as well, but they charge you horrendous amount of money for financing it. It doesn't have to be like that. And it helps to curb and drive and accelerate the investments in infrastructure. A country like Ukraine that will need it shortly,
Yeah.
it's going to be hundreds of billions of euros.
No, absolutely, no doubt.
Yeah. So I see a space in here.
No, I agree, and it's very interesting. Actually, this was a topic. I was in Madrid at Michael's very good SCF conference a couple of weeks ago, and this was a topic there. I was speaking to a lady called Sandra Nolasco at Twinco, who's doing exactly that, trying to drive supply chain finance through those various stages, because you're absolutely right. Without that critical financing at even the purchase order stage,
At the very beginning.
how do they then necessarily get hands on the necessary materials or whatever those might be in order to fulfill the contract and sorry, it's fine once you've got an invoice and it's been approved, but that may be
much later.
40, 60 days too late to kick things off on time. So yeah, I think that pre-approval phase is a really interesting side. Magnus, where do you see the opportunities here?
Yeah, I think if talking about, for instance, the smaller suppliers that rarely gets offered this chance, I don't think they ever will get the offer from a tier 1, tier 2 bank, simply because the banks can't afford the admin and the KYC doesn't make economical sense. But we were talking about this, I think, over lunch. What I would do if I was a relatively strong buyer, I would join forces with a non-bank factoring financing company, and then I tell them, here's the list of my smaller suppliers. They are informed. Please feel free to contact them. Don't you dare overcharging them because they're banking my good rating. And that's an excellent business opportunity, but that should be with a quick and lean financial institution that is not a bank. And then it's just regular receivables finance. And I think that's a fairly simple way of doing it, which could work for the smaller ones.
Absolutely. And what about the kind of the advent of multi-funder type platforms? You've got more and more of these who, for the buyer, there seem to be fairly good benefits. It's one set of KYC, access to a number of funders. Is that the right solution for the buyers? Is it the right solution for the funders? I mean, from an insurance perspective, do insurers like that kind of business?
I do, because I also like non-bank funding solutions. But if you think of supply chain as a train, the first question is always, who's driving this bloody train?
Yeah.
And multi-financing indicates that, okay, either you have a strong lead financier or you have a strong platform provider, market maker. But as long as you can answer that question, who's driving the train, I think absolutely all four.
Makes sense. And Senem, would your bank see things the same? Would you be interested in financing a multi-funder platform, or would you rather keep control and drive the train yourselves?
Yes. So I think when there are multi-funders in the platform, it depends on, I think, how big the bank is, because the bigger banks have lots of resources, and in terms of cost of funding, they could be very competitive. So in this type of platforms, we need to allocate some resources, especially on the IT side. We have to make some connections, and some infrastructure needs to be completed. So perhaps smaller banks would prefer more exclusivity for the transactions, so that after all this work done, probably it won't be a preference to compete on the pricing side with other bigger banks.
Understood. That makes total sense. And Gabriele, let me quickly tie you in on...
I just want to add on, we have
Please,
8 minutes, on this platformification topic, because we're seeing it from our technology vendor point of view, that there is a lot of interest coming from markets out there, everywhere. Name it India, name it the US, name it Mexico, name it further in Asia. We haven't seen it in Africa yet, but where they come to us and say, do you have a platform? We know that you do factoring and you do supply chain finance, but can you provide us a platform and we're like, yes and no, right? We have a syndication module, which in principle allows you to split the risk in a portfolio of receivables. So kind of, but it's not the real thing. So we see a big tendency in that direction, where you have different financiers that would like to share the risk in buying a portfolio of receivables from a company.
Are they predominantly bank, non-banked? Is there
everything?
Right.
Everything, regulated, non-regulated markets, you name it. So, but it's a trend. I'm just telling you what we're seeing, and that there's a definite direction into that space. So it's not whether yes or no, it's happening, and it's the question is it going to grow further and generate more business? Yeah.
Interesting. Great stuff. Thank you. Sorry, Gabriele, as I was going to just about ask you, one of the other big topics, of course, is always the tail of supply chain finance, looking at the SMEs, which is largely untouched, I think, because of the way that the predominant funders, the banks, tend to view that kind of risk. Obviously, I know the guys here at Supplier Plus are doing a lot of work around helping to finance that. But with your SME expertise, where do you see the opportunities to help funders, and with what kind of instruments do you think it's best to finance the tail?
Well, yeah, I guess you're absolutely right, Ben. Banks traditionally haven't been really great in that space, and that's why I guess in the last probably 10 years we've seen a lot of non-bank lenders really coming into that space, doing a fantastic job in supporting SMEs for supply chain finance. I think one success factor we see all the times with our clients is having a good platform, so a lending platform end-to-end that can fully support digitalization and automation. I think that's the key, right? Having a good platform is probably a good starting point to connect all different APIs, to connect all different data sources, to ensure you've got a clear process flow. You can import the right data, and everyone from the moment you receive a lead to the time where you disburse money or invoices get paid, you have a full reconciliation. So that is clearly a success factor, especially if you're operating in the SME space where probably volumes are very high, and so you clearly cannot do that manually and try to reconcile all that manually. So that's one. I guess the other element that can really help in that space is what type of offering and product offering is there. So most of the times, again, I think this has been mentioned before, try to be creative in terms of moving a little bit away from the traditional factoring and setting limits at counterparty level, allowing basically a customer to choose which invoices they want to insure, not necessarily the opposite way. So all these elements really help SMEs, obviously, to use this tool more, because actually this is the point. Supply chain finance can really help SMEs in better managing their working capital, and this is key. And there should be a lot more there, out there to help them to get used to this product and use it in the right way.
Perfect. Thank you very much. Karel, I will ask you to finish us off just before I ask one final question from the floor. But in your experience of kind of seeing organizations supporting supply chain with financing, where have you seen kind of innovation, people taking the opportunity to provide interesting forms of financing that has the same fundamental effect to support those suppliers?
Interesting question. Well, I would say that there is probably like more and more disruptive solution being put in place, I would say, in a way, because as we mentioned, macroeconomy challenges, energy pricing, interest rate as well. So as we said, suppliers trying to find the best solution now to get financed, they need to get financed at a cheaper cost. So either they will join some buyer programs, they are setting some programs themselves as well to ensure also the whole supply chain sustainability. And I think that what I see as an advisor more and more, that there is more and more requests on of course receivables, ABL solutions, factoring solution, even securitization solutions, but also payable, different type of payable solution between the SCF, regular standard supply chain finance, but also dynamic discounting or even cards for the long tail, as we were mentioning. And now is coming as well the inventory, because I think that companies, they need to finance their working capital overall. So it's also another area where we see a demand increase as well.
Fabulous. Thank you, Karel. Unless one has anything particularly they want to add there, I will ask the last question from the audience that I wanted to ask. This goes actually back to kind of when we don't necessarily have all the right data, but is there a good source of granular data on the applicable credit risk of the reverse factoring space, i.e. default rates, recovery rates, things like that? Are there any great resources that people can go to? Magnus.
Well, yeah. The insurers, but they're not going to answer, I guess. But they will have the data. Brokers, our company, for instance, collect that kind of data in every dimension. Not sure exactly what who asked the question, whether they want to build the data themselves or if it's a concrete case. But yeah, data is out there. But you need to obviously find someone in this chain, either a bank, insurer, platform that sits on multiple cases.
So the data's there, but it's about the ownership of that data and whether they're willing to release that data.
I can tell you from our case, our largest client is not using insurance. They do they do it themselves. They have the data, they analyze the data, and they know what's going on.
You have their business card, please?
Any of our online participants got anything particular to say on that? Any particular sources of data you're able to share with the audience here?
11.
Looks as
10,
though we are ticking
5.
down to zero bang on time. In which case, I would just like to thank the panel. Thank you guys, some really interesting bits there. Such a big topic. There was plenty more for us to delve into, but we'll get into those another time.
Thank you.
Thanks, everyone.
Thanks.
Thank you, guys.
Thank you.
Thank you.
Actually, I've got a question. Maybe this is for Magnus, but I'd just like to try and get things in perspective in terms of the development of technology and risk management tools. And I'm thinking back to the time of the 2008-2009 banking crisis. And at that time, I recall that a lot of credit cover was withdrawn, sort of more or less overnight, and it caused a huge number of problems for businesses. I mean, given the sort of advancement in credit management analysis tools between now and then, do you think there could have been a different outcome at that time if the tools and analysis that is available now was available then?
Yeah, and I think actually you already have the answer. The COVID crisis, several crises after that, the reaction has been completely different. And you're spot on. The one reason why all this cover was withdrawn was because they were clueless. They didn't have any kind of data set of what risk they were on. And so if you look at it today, the credit insurers have complete control of what risk they have out there. And so information. Again, the data has changed everything. The access to the data and the ability to sort it and mine it is completely different.
Yeah. So the sector is in a much better position
Much better.
now than it was then. Okay, that's interesting. Good to know. Okay, thank you very much, Ben. Thank you, panel.
Thanks.